You're listening to a classic business podcast as heard on Classic 1027. 1027.
Well, the JSE was swept up in the festive mood as December kicked off, with most global markets drinking the eggnog of vaccines and potential stimulus. The all-share 0.5% firmer on the day. We ended up at 57,509 points, up 0.7%. The rand strengthening against a weaker dollar to 15 rand 22 against the greenback. And looking at gold, another little bit of light for the luxury metal that had started to lose just a little bit of its shine over the last few weeks, currently at $1,805 an ounce. In Europe, we also saw the stock 600 ending up just under 1% on the day. And over in the US, it's been a strong start to the final month of the year. The Dow up 1.4%, the S&P 500 a similar amount, and the Nasdaq up 1%. We've got Mike van der Westhuizen, portfolio manager at Citadel, on the line with your view from the market. Mike, ho, ho, hum. How are you reading the market sentiment as we enter the last month of the year?
Yeah, geez, you'd think after a extremely frothy November, you'd have, somewhat of a slow start to the month, but it's full on in. As you mentioned a little bit earlier, I think markets are still stuck on the hope that the vaccine will be, approved and rolled out, and that stimulus will come through in the amount that that is expected by the market. So for now, still very, very good news, and I think that. If you just look at positioning, and specifically in the S&P 500, it's record low shorts on stocks, record buying of call options on the index, sentiment at close to greedy type levels. So everybody's in it to win it at the moment.
In it to win it. There is no alternative. Tina is another word that you could probably throw into Merriam-Webster's word of the year if you are in markets and traders, because there has been a world awash with liquidity, stimulus to be that bridge through this natural disaster, for lack of a better word, that COVID-19 has been. And so you're finding a lot of this excess liquidity now looking for a home, and rather than pay for the privilege to hold sovereign debt, if you AAA rated Canada or any of the other negative yielding sovereigns, equities are the place to park your money. Rob, what stood out for you as we finally have you on the line? Rob Towell, portfolio manager at Sasfin Securities.
Yeah, thank you, Mike. There's just nowhere to put funds if you want to get some type of return with yield so low. So the money is flowing back into equities, and it's a mix at the moment. People are worried a bit about gold. They think it's going to come off, but the money flows back as soon as it sells off. We also see money flowing back into the tech stocks offshore. And then locally, obviously, there is a little bit of money flowing back into South African Inc. So the volatility is still here, and it will be here for some time as people get through the vaccine and where interest rates are going to go.
And that is the big question, the vaccine. How long is that going to take to roll out? If you look at Goldman, they reckon we'll have 85% of the developed world vaccinated for SARS-CoV-2 by the fourth quarter of next year. That doesn't say too much about the developing world and what might happen there. So it still shows that there is still some water to flow under this particular bridge. Looking at local high-frequency data, it always comes thick and fast on the first of the month. We had the ABSA PMI coming out, Mike, and showing that manufacturing was on a good wicket. We had seen an improvement up to 60, but it's come all the way back down to just above 50. 50 or above is still an expansionary territory, but it shows that manufacturing in the country is still very weak.
Definitely.
Mike?
Definitely. We have seen some slowing momentum. If you look at the underlying sort of quite a big fall in the new sales order part of the component, back into contractionary territory, and a lot of that was to do with declining in exports to some of the countries in the EU where there's renewed lockdowns, and also there's probably some softening of domestic demand. So naturally after the lockdown we saw quite a pickup in pent-up demand, and that's sort of tapering off a little bit now. And then also just forward-looking, I mean, it's quite apparent that some of the smaller companies are sort of don't have as rosy a view as some of the bigger companies out there when it comes to the manufacturing sector. So sort of a mixed bag in terms of views in that part of the sector.
And that is why it's such an important data point, because many analysts were saying be careful of reading too much into the early PMI numbers as we exited the hard lockdown into the lower levels. It could just be a factor of pent-up demand, and it does look like that is the case. In the new vehicle market, Rob, we see local vehicles recording their fastest pace of improvement since the onset of COVID-19, as we see both the rates of contraction in domestic sales and exports falling to their lowest levels since March across all vehicle categories. So good news this for a local vehicle industry that has been under significant pressure.
Yes, it is good news. I think that some of it is still pent-up demand. I think that prices also haven't moved up as quickly on the vehicles as before. We've also had lower fuel increases, etc. So all help in there. I think we'll also be interested to see how long it lasts for, and how much of it is pent-up demand, and how much of it is coming from new growth. So we'll have to see. I think it's a bit early for the data point now to look into it for too long, but you see it in the numbers. You see Imperial, Motus, Supergroup all picking up with data points like this.
And interesting to note that Barlow is yesterday announcing that long term it doesn't see itself in the automotive vertical. Mike, to bring you in here, Barlow saying it's more of a counter-cyclical soft commodities, sugar, starch business that it picked up from Tongaat, and then obviously the yellow machines, the caterpillars and earth-moving equipment that feed into construction and mining. But I want to move on to another vehicle manufacturer. You could call it a technology company, Tesla, and the full weight of Tesla is going to be added to the S&P 500 on the 21st of December, just ahead of Christmas. And it's quite an unprecedented step, this. So why?
Oh, the craziness continues, I'd say, in that stock. I mean, the stock's up 580% year to date. There was a talk of how it would be phased into the index, and the vote came through that it would probably be put in at its full market cap, or free float adjusted market cap. I mean, the market cap is about 538 billion. So it makes the largest, market cap company to actually make its debut in the index. And just for context, I mean, that puts it somewhere between Visa and Berkshire Hathaway. So it's about 2% of the index. So you can imagine the scrambling that's going to go on there. Index funds having to buy ETFs, having to buy. I mean, the prices already run significantly leading up or post the original announcement of index inclusion in November. So, I mean, the froth is there. And just looking at some, I sort of expected to run up more going into the index. But like we saw with Facebook going in a couple of years ago, I mean, after that, I think a lot of the punters or the speculators will then start to sell again. I mean, it's pretty unsustainable given sort of where Tesla is in terms of profitability as well. I mean, the fundamentals versus price have diverged quite a bit.
Quite a bit, to say the least. That might be the understatement of the year. I mean, you've got to really believe that this is the future of not just motoring, but of transport, of the way we get around effectively. And it also means, with this froth that we've seen in the Tesla share price, Rob, to bring you in, that Elon Musk became the second richest person in the world recently, second only to Jeff Bezos. And there's a long-running rivalry between the world's two most powerful CEOs, and Musk will be hoping that this inclusion in the S&P helps narrow that gap even further.
Yes, it's amazing actually how quickly he's got to that point. You went straight past Facebook and straight into the second richest. It's unbelievable actually. But if you take a look also at Tesla, it's not the only company in the sector that's doing that. If you take a look at NIO, which is the Chinese electric car company, they're up 2,000% this year. So they're not the only ones in the sector. So money flowing into the electric vehicle sector, blindly at this point. And a little bit like the initial spending that went into Amazon many years ago. A little bit early, exactly what it's going to be, no one really knows, but people carried on putting money into Amazon. And then, everything about Amazon and where it was going came to fruition. So, that is where we are with Tesla and the electric car companies, and maybe we see that with a BMW, a Daimler, or Volkswagen going forward.
And as this is happening, we see OPEC Plus still bickering and quarrelling about whether or not they're going to be implementing production cuts. It does look to be like the old fossil fuel industry is really battling to respond to the disruption of electric vehicles and position itself for the future. What do you make of this latest postponement, Rob?
I think they are under pressure. I think that there's a glut of oil in the market at the moment, and they don't know what to do with it. Normally, these cycles are not so long, and economies are not closed totally. I mean, I think that the airline industry uses a lot of that fuel. They've been closed for months on end, so they're under pressure, and I think that it just shows you how difficult it is in the oil sector at the moment. Fossil fuels will be here for many years to come, still, but the rate of change is getting quicker.
The rate of change is increasing. Mike, when we look at earnings, Nampak and Redefine, the two that stand out today, both make for very difficult reading. Let's start with Nampak, the paper and packaging company, still labouring under the weight of debt and its balance sheet. Ooh, I think we've just lost Mike. Rob, what did you make of the Nampak numbers?
Yes, so they're still battling, and I think the share price has actually done a lot in the last month or two. But when you read the lines, the debt is a big, big problem. They can't really clear that debt. Well, operations are starting to improve. It's not quick enough to pay off such huge debt amounts. So that is a problem. And then you need GDP growth. So they really are very closely linked to GDP in Angola, South Africa, Nigeria. All three big countries are battling. And while they've done a lot of change, they've fixed the business immensely. They've reduced costs immensely. The GDP is what they need, and they need the growth. And they're not going to be able to get out of the hole without GDP growth. So, if we start to get some infrastructure spend, if the economies do come right, it's going to be a very good investment. But it's very early to tell whether our GDP can recover yet.
And still battling, obviously, with Forex issues in many of those African operations. Getting Forex out of the country, particularly in Zimbabwe, that is a big challenge. And obviously COVID doesn't help when entire lines like alcohol are shut down, and that you're a big bottler and packager for the alcohol industry. And then Redefine, we know the REIT industry has been decimated by COVID. Properties have been revalued down. We see rental reversions are pointing in the wrong direction. Vacancies are increasing. If you take a walk down Fricker Road, it's just a bloodbath out there. That said, Redefine seems to be confident it can come up with a solution that will keep REIT status. It's going to potentially give shares in cash. The CEO, Andrew Koenig, was keeping his cards close to his chest today at the announcement. I'm going to chat to him a little bit later. What did you make of the Redefine numbers?
Again, the market is so difficult at the moment. And the problem that we have is there's a very big possibility that properties can get written down still further. And I think that the loan to values for these REIT companies is getting bigger and bigger. And as they try to sell off businesses, sell off properties, they can sell off small properties, but very big properties are hard to sell, and they're getting the wrong prices for them, at least according to their book values. So while they are doing their best to keep valuations up, property prices are still coming down, and therefore you leave you at risk with the loan to value and leaves them under pressure to remain with their REIT status. So yes, they can, pay dividends by giving extra shares. They can do rights issues, but there's really little money available for REITs. Banks are not lending into REITs at the moment either. So still a very high risk sector to be in and difficult place to be in. Bukere's numbers were not too bad and were a little bit more positive yesterday. But Redefine has still got a lot of problems.
Rob Tawell, Portfolio Manager at Sasfin Securities, and Mike van der Westhuizen, Portfolio Manager at Citadel, with your view from the market.